Hello and welcome back to Intro to Business. This chapter, Chapter 4, really deals with what I refer to as business associations, but that's a term that's sometimes used in the legal environment more. You could just as easily refer to this as entity selection, or basically choosing or thinking about what kind of business your business or a business you might be evaluating should be. There's a variety of different business forms: sole proprietorships, partnerships, corporations, S corporations, limited liability companies, limited liability partnerships. And we want to go through a bunch of these different forms or entities or associations, whatever global term we want to use to describe them, and become familiar with the characteristics and the advantages and disadvantages. Just so we can kind of have a sense of why certain businesses take the form or the structure that they do. So that's kind of our goal. And when you try to evaluate a business and determine what the appropriate entity should be, there's a multitude of factors, and there may not be a right or perfect answer, because some of these factors are going to be they're going to be trade-offs. So one of the first things we might want to think about is what's the setup involved. So forming a sole proprietorship where you hang out a shingle by yourself is probably the simplest setup, whereas a full-blown publicly traded corporation is probably the most complicated setup. And then there's a variety of levels in between. Other factors include control, whether or not you want to maintain exclusive control of a business endeavor, or whether or not there's going to be some kind of shared ownership structure, and as a result, some kind of shared governance structure with, say, a board of directors, for example. You may want to leave the business to just a single person. So there are some businesses that are structured for particular reasons because they have family succession plans in place, or they're trying to accomplish something along those lines. Of course, taxes is a large expense, and we'll find that some of these entities are taxed at the entity level, and then also the distributions may be taxed. And then other entities will not be taxed at the entity level. All the taxation will take place on the distributions or whoever receives the benefits of the business. And so we'll see that play out as well. Sometimes you need a different type of entity because you need to gather different skills. So there's a reason why a lot of professional firms end up being partnerships, because that's a convenient way to get attorneys who have different skill sets, or accountants who have different skill sets, or engineers who have different skill sets. And a lot of those professional people prefer to be partial owners rather than employees. And so, a partnership situation can make sense in that environment. Whereas if you're a sole proprietorship, you may be limited to just your skill set or those skill sets that you can hire. And sometimes you need to offer people an ownership interest in order to attract better help, or to make them part of the profit of the business, because maybe you can't afford to compensate them as an employee. And so what you do is you compensate them with profit sharing by making them an owner or partner in the business. Continuity is how long the business might last. Sole proprietorships die when the proprietor dies, and you may have a business endeavor that you want to have last for a longer period of time. And so our more continuous types of businesses tend to be on the corporate side of things, but we'll discuss all of the specific attributes when we get to the different businesses. Financing can be important. Certainly, as you add more owners or more partners, you make it easier to raise more capital. If there are three of us that are partners, we have all of our three checkbooks and life savings to work with, whereas if it's just a sole proprietor, they really probably only have their personal resources to work with. And when you become a corporation, then of course you can have a slew of shareholders, all of which may be providing capital to the business. And so the level of financing or the amount of capital that you need to raise to bring into your business can have an impact on your entity selection. And last but certainly not least would be liability. More formal business structures and organizations can limit the liability of the owners and the operators to just the amount they have invested in the business. Other less formal business entities have liability that extends beyond the business activities to just the proprietor or the partners. And so this can be problematic if you have a somewhat risky business endeavor and owners who have a relatively significant asset pools that they're trying to protect at the personal level. So these are all the types of things that we have to consider when you're looking at which entity to choose. And so let's start with sole proprietors. And I'm sure you're familiar with these. I often ask people, if they've ever been a sole proprietor, and people say, well, no, not really. And then I ask a different question. I say, well, how many of you ran a lemonade stand as a kid? And if you answered yes to that question, technically you were a sole proprietor. And it's really that simple. A sole proprietorship can be set up. It can occur just at the moment that you make a sale. And every once in a while I find people that are proprietors and they kind of didn't really intend to be. They sort of started doing a few transactions, and those transactions accumulated to the point where they had a business, whether they wanted it or not. So it's very simple to set one of these things up. You may, now I'm going to go into more detail here about several things. So you may want to get a business name. So you would go to the Secretary of State, and we've included a link in the Moodle site where you can go to that and do a form called an assumed business name, or a DBA, which is a designated business association, and give yourself a name that's other than your personal name. And so if you want to advertise your business or make business cards or do something of that nature, usually you do a DBA, or an assumed business name. And there's just a fee for that. It's collected at the state level so that everybody knows all the businesses and who the people are behind any given business entity. A sole proprietorship is going to be a pass-through entity. So it's going to not pay any taxes at the business level. All the profits from the business, so the revenues minus the expenses, the profits are going to be attributed to the proprietor and reported on the proprietor's tax return, and that's going to be reported on a Schedule C as part of their 1040 series tax return. Now, a proprietor is also going to have unlimited liability. So if I start a business as a proprietor and a customer or an employee, let's make it pretty dramatic, they lose their life on the job or as a result of doing business with me, I'm going to be responsible for that, not only with my business assets, but all of my personal assets potentially. And so this level of liability is very concerning. And so depending upon the nature of your business, that might be unacceptable. And we'll see later that there's some things that you can do about that by choosing different entities. I mentioned earlier that the proprietorship is going to end with the end of the proprietor. So if you have a business and the proprietor dies for whatever reason, that business is technically kind of defunct at that moment, and there has to be either it wraps up and closes, or there has to be some kind of a restructuring that goes on to change the business into a different form or to a different owner at that point. Another interesting thing, it's kind of overlooked by some people, but a sole proprietorship can't title assets. So you can't have a company car in the business name, you can't have a piece of real estate in the business name. It's simply just not possible. And that can be a bit of a problem, just depending upon what you're trying to accomplish, or if you have an asset-heavy business, then having all of those ownership interests unseparated from the proprietor can be a challenge. And so those are different factors. I think the main attraction here to the proprietorship is just how easy it is to get started. And so I find people will do this when the business has a relatively low risk, and oftentimes if they just want to sample or try a business out, and then as the business becomes more successful, then they may change entities to something a little more sophisticated. But when you're just getting going with something, this is a viable starting point, so long as your risk exposure is limited. So partnerships fall along a similar line to proprietorships, except you've got more than one owner. So you've got at least two. You could have, in theory, a huge number of partners in a partnership. Some of the very large law firms and some of the very large accounting firms have an immense number of partners. So that is possible. I think the norm low, what we think of, I think of partnerships as like 2 to 20. Usually a self-contained unit of people that are kind of working together in a similar geographical location. But it doesn't have to be that way. That's just kind of how I think about it. Some of the characteristics here, you still have unlimited liability, and the difficulty here is that the liability extends to all the partners. So if one partner does something, I don't know, say one of the partners goes out for a business luncheon and has several martinis, and then, that's the 1950s business lunch, and then proceeds to bump a school bus off of the I-5 bridge that crosses the Willamette on the way back from lunch. Well, that partner is probably going to spend some time in jail, so they're pretty much going to be bankrupt, but so are all the other partners, because technically they're responsible for that act as well, because the partner was conducting business and acting in their partnership capacity when that event took place. The moral to the story here is that you need to choose your partners very carefully if you don't have any liability protection, because you're now responsible for not only what you do but what they do as well. So that's a kind of a troublesome barrier to think about. One of the advantages is you get a larger pool of people. Now, partnerships, I want to confess here, I am a little bit biased against partnership, because in my practice, I've been involved several times with helping clients get out of partnerships, because much like, well, I hate to say this, it's kind of unfortunately, both marriages and partnerships end up in divorce from time to time, and it can be difficult to unravel a partnership. So sometimes they don't work for that reason. But some of the exceptions that I've noticed is when partners bring unique and specific different skill sets to a partnership, and they perform or serve the partnership in a different way. So some of the partnerships that I've seen that really work well is an architect working with a builder, because each one is doing a different aspect of the job, and they're not bumping into each other or having differences of opinion about how to do their part of the job. So partnerships in that way, they can pool and bring together different skill sets, and when combined just right, they can have longer term viability. And of course, you can raise more money here, because you can tap into both partners' savings as a source of contributions to the business. The partnership will not pay taxes at the entity level. The profits, along with the guaranteed payments, will be passed through to the partners, and the taxes will be paid at the individual levels rather than at the business level. A partnership can title assets, unlike a sole proprietorship, and so that's a difference here, I guess. I would say that it's normally a great idea to have a partnership agreement. You do not have to have one. You can literally do a handshake partnership agreement and find yourself in a partnership. It is probably, and when you do that, by the way, you're generally governed by your state's partnership law, which is the Uniform Partnership Act. And we didn't put a link to that in the Moodle site, but I probably won't actually. It's something that's usually covered in a business law class, so you'll pick that up somewhere down the line. The partnership agreement, doing a separate agreement is really a spectacular idea, because I think a lot of people will start partnerships and they think they know how they're going to work. And by sitting down and actually mutually agreeing to a partnership agreement and spelling out all of the details, if nothing else, it creates a lot of clarity for the partners so that there are less surprises. And one of the other key ingredients that you generally address in a partnership agreement is what happens if one of the partners wants to leave the partnership, or if one of the partners dies or becomes unable to work anymore. And so you have to have exit strategies for these types of situations in a partnership, because just because you need them, because there's no other way for things to work. So limited partnerships are a little bit more complicated partnership. They carry the same general characteristics, but some of the partners now, rather than being involved in the business, are simply like silent partners. They're just investors in the partnership. So you've got maybe a handful of partners that we refer to as managing partners. They're operating in the business, and they have full liability. They don't have, or the unlimited liability that we've been talking about. But the non-managing partners, or the limited partners that are really just providing the investment capital, now their liability in a limited partnership is limited to their investment. And so there's generally, it doesn't extend now to their personal assets and their other financial resources. And so that can be kind of an attractive way to assemble an entity that has flow-through taxes or pass-through taxes like a partnership, and has the other partnership characteristics, but limits the liabilities to, or liabilities for, the partners that are really just providing capital. You'll find some publicly traded master limited partnerships. Sometimes when people want the tax advantages of a pass-through entity, particularly you'll find this in oil and gas exploration. You'll find this in certain real estate investment trust types of activities, where there's significant investments and a lot of assets that are subject to depreciation. Then sometimes people will want to be investors, get cash flow, but may end up being able to show a paper loss because of some neat tax tricks that go on. And so large limited partnerships kind of fall into categories such as that. Corporations. I think we're all familiar with corporations. All the big companies and brands that we're kind of familiar with, and of course you can never say all, but many. The Apples, the Nikes, those are the two companies that just kind of come to mind right away. Microsoft. A lot of those businesses are corporations, and of course they have a limited liability. They're an entirely separate legal entity. They are taxed at the business level, and then when they pay dividends to the shareholders, which are the owners, those dividends are taxed also, or are potentially taxed also. It's an easier way to raise capital because you can sell a lot of shares to a lot of different people for a relatively lower amount. Imagine if we form a partnership and there's two of us, each of us have to fund, say, 50% of it, which might be a lot, but say we form a corporation and there's 5,000 of us, the amount or the share price can be a lot lower. And so this can allow you to spread the ownership across a larger pool of people that each contribute maybe less in total, but because there's so many of them, it ends up being more capital overall. When you get into a finance class or a financial accounting class or some business subjects further along, you'll get to know corporations in greater detail and understand how they're funded and capitalized a bit better. They also have continuity. That is, if any given shareholder or any given member of management happens to pass away, the business still exists and the business still continues along. Now, I mentioned a couple of big corporations, but corporations do not have to be publicly traded and they do not have to be big. You can get a 3-person or a 3-member board of directors with 1 shareholder and 1 manager and create a corporation. And if you dig around on the Secretary of State's website, you'll find the paperwork to do that. It is not necessarily all that complicated, and it is not necessarily just a big business idea. But if you're looking for continuity and if you're looking for limited liability and the dual taxation doesn't scare you too much, then it's a completely viable way to go. The downfalls here would be that you generally need bylaws, articles of incorporation. So these are governing documents that describe how you're going to function and operate. And you do normally need a board of directors. And of course, the shareholders are the owners of the business, not necessarily the management. Speaking of corporate terms, so shareholders, those are the owners of the shares which own the corporation, which elect the board of directors, and the board of directors hires the management of the corporation. So that is how the governance structure works. Generally, the corporation will return dividends or buy the stock back in a stock repurchase, but generally the corporation will work for the benefit of the shareholders, and so those benefits are generally dividends, growth in the share price, or the possibility that the corporation will use its excess cash to repurchase shares at a hopefully an inflated price from the shareholders. And like I mentioned before, they can be publicly held, which means they are publicly traded corporations, either on the New York Stock Exchange or on the over-the-market NASDAQ exchange or in one of the other exchanges around the globe, or they can be just simply a corporation that has shareholders and a board of directors and management, but the shares are not publicly traded. And so in that case, they may be privately bought and sold, but there's some restrictions on how that works. And so it's a much more limited pool of shareholders at that point. So here's, this is an interesting slide, figure 4.5 from the text. By far, sole proprietors are the largest number of businesses in the economy. So I think you can see here there's 72% of all of the businesses known, partnerships 10%, and then corporations only 18% in terms of the number of entities. But when you look at the sales revenue, the corporations are, they're 82%, so they're disproportionately large. And that's because, mostly that's because in order to be a very large business, you're going to have a complex business, which is going to need liability protection and also the ability to raise much more levels of capital. So what we find is that the bigger businesses which generate the revenue tend to be corporations because of those two key characteristics, the limited liability and the ability to raise more capital. So you can see that these different things have impacts on the entity selection. So one of the things that's happened here is that there has been this need for some hybrid organizations. So we have the proprietorships and the partnerships that kind of have that full liability exposure. And then we have the corporation that has the limited liability. And the partnerships and the proprietorships are flow through in terms of taxation, but the corporation is a non-flow through in terms of taxation. And so at some point somebody said, well, could we mix these characteristics up differently, and could we create a entity that has limited liability but still has flow through tax characteristics? And so we have the S corporation, which is a small corporation that's going to be a pass-through entity. So it's not going to pay any taxes at the corporate level. The taxes are going to be paid at the shareholder level, and each shareholder is going to get a pro rata share of the corporation's profit that they're going to have to report as taxable income. So that's a flow-through or a pass-through taxable entity, but it has limited liability because it registers with the Secretary of State. It has articles and bylaws, board of directors, regular board of directors minutes and meetings, and so it's like a corporation for liability purposes, but it's more like a partnership for taxation purposes. Now, it is limited to 100 shareholders, and those shareholders generally have to be, they have to be individuals. They can't be other corporations, and they can occasionally be this weird kind of trust. It's not even a weird kind of trust, I just use that term, but it can be a trust, which is kind of the unusual exception. But it can't, partnerships can't own shares in the S corporation. They generally individuals, and then occasionally a trust that represents individuals. It is still a separate legal entity, so it can title assets, it can own property, it can do all of these things that a regular corporation can do. It just has the pass-through tax characteristics, and so that's a very attractive entity when you're looking for more significant liability protection, but you don't necessarily want to be a full-blown corporation. Another hybrid that is less, it doesn't have the duration of the S corporations. The S corporations have been around longer, but we have these things called limited liability companies. And a limited liability company, an LLC, or for that matter, you could have a limited liability partnership. A limited liability company, think of it as a sole proprietorship that has jumped through a little bit of hoops with the state to become registered as a limited liability company. Now, they don't have articles of incorporation and bylaws like a corporation does, because they're not a corporation. So they have what's called an operating agreement. And so they do some paperwork with the state, they file an operating agreement, they start to hold themselves out by changing their invoices and their business cards and their letterheads and all this stuff to say limited liability company. And if they do all of the steps properly, then the owner now has liability that's limited to the resources they have deployed in the business. It can still be a pass-through entity, although I want to be careful here, it does not have to be a pass-through entity. So this, from the IRS perspective, this is what's referred to as the check the box situation, where you literally decide which tax treatment you're going to accept, either pass-through, which would make you a proprietorship or a partnership for tax purposes, or a separate entity, which would make you a corporation for taxes. But either way, you're going to have the limited liability. There are some reasons why you might want to be a corporation for tax purposes, and they primarily have to do with benefits and a few other characteristics that are beyond the scope of this class. I just wanted to say that. Easier to set up than a full-blown corporation. Easier to operate because you don't have to have, you usually have to have an annual meeting for your LLC to update your operating agreement and these types of things, but you don't have to appoint a board of directors, and you don't have to elect a board of directors, and you don't have to sort of do some of the more formal things that a corporation needs to do to be in good standing. Can be owned by all kinds of different things. So the S corporation, which would be an alternative here, can primarily only be owned by individuals, but the limited liability company, well, a limited liability company usually we think of as a sole proprietorship, but a limited liability partnership, those partners could be a lot of different things. So two corporations could come together to form a limited liability partnership that was going to do some specific business task, and they could therefore limit their liability to the resources they had deployed in the limited liability partnership. And so you can kind of arrange and do these things in a lot of different ways. Limited liability companies, separate entities, so they can title and own assets. They're really a spectacular alternative for a proprietorship or partnership that just for whatever reason needs some liability protection. Say you were going to own a food truck. Food's a pretty serious matter. You can make people really quite sick, so it's a high risk endeavor from a legal perspective. You don't necessarily have to have a lot of capital because we're talking about a food truck, and it's probably just a one-person ownership kind of thing. So it's either a proprietorship or here, because you need the liability protection, you would definitely want to become an LLC, probably a pass-through LLC, so that you could gain the liability protection, and that would certainly be a great thing to do. With all of these things that I have mentioned, one of the things I want to point out is that entities are governed, or I guess governed is the right word, by the states. And so, almost all the rules for corporations and for S corporations and whatnot are pretty much the same from state to state. But because limited liability companies are relatively new, I think the first one was in, maybe it was Wyoming in the 70s when they passed the law making limited liabilities possible. But because they are newer and they basically vary from state to state. I'll give you one little nuance. You cannot form a limited liability company in California that delivers healthcare services. It's just not allowed under their code. And so think about that for a minute. You might form a limited liability business to be a dentist in Oregon, and it might be appropriate and legal and functional in Oregon, and I don't know if that's true, by the way. I'm just making this up. And then you could go to do that same thing in California and find out that it just doesn't work. And so you need to, with an LLC or an LLP, you need to become familiar with the liability laws and the business structures in the state in which you're going to primarily operate. And so that's just a word of caution, something that you need to consider sort of above and beyond things here. So that is a very rapid overview of business entities. So our proprietorships, our partnerships, limited partnerships, corporations, S corporations, limited liability companies, and limited liability partnerships. You will see this discussion of entities expanded a lot when you take a business law class. It will be expanded some when you take some accounting classes, and it will be expanded more if you were to take a tax class. Basically, all of those classes are going to sort of go into greater detail in their particular areas. So in a tax class, they would always cover the taxation of these business entities in a lot greater detail than what we've done here. And in a law class, they're going to get into the liability issues and the asset titling issues in much greater detail than we have here. And in an accounting class, there's going to be more discussion of how you set up the ownership interests and how you track the ownership interest and what the accounting looks like for the distributions of either profits or different things to the different owners, from an accounting perspective. And so, again, this is just the beginning. There's a lot more to learn and know here, but I think it's a good foundation to build off of. So I encourage you to look at the chapter well and start noticing. This is an easy thing to just sort of notice. Every business that you do business with you can start to, okay, that was a corporation and they're a large company and they do this X. Or you may go to a healthcare provider or a dentist or maybe to a restaurant, and you might start to pay attention to how are they structured and how are they organized and what kind of entity did they choose to be. And if you have the luxury or the opportunity to talk to business owners, you might ask them, what kind of business are they and why did they choose that one? And if you do that for just a little while, you'll start to get a real sense of where the divisions lie and what are the key factors that cause people to choose one entity over another. So that does it for this chapter. Thank you very much for tuning in, I guess, and we'll look forward to whatever comes our way in the next chapter.